from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
This is Bloomberg Technology. Coming up in the next hour, Juul ordered to pay almost $440 million to settle a probe over the e-cigarette maker's marketing to teens. But the company still faces hundreds of lawsuits. Plus, the rise of the creator economy. We're going to take a deep dive into this booming industry and how YouTube in particular reigns supreme as platform of choice. But TikTok is catching up. And it's back. The NFL season starts this Thursday, which means more sports betting on sites like DraftKings. Our conversation with CEO Jason Robins on what to expect as we kick off this week's Sports Tech series. All of that in a moment, but first let's get a look at the markets and the tech sector leading the declines as markets continue to fear a more hawkish Fed. Bloomberg's Ed Ludlow is back in San Francisco with the latest. Ed, welcome back.
Yeah, I've sat out a few painful weeks in the markets, but stocks in the red, tech underperforming, really becoming a familiar story. US services data on Wednesday, stronger than expected, reinforcing the idea that the economy can withstand higher rates, that the Fed will remain hawkish. That says that the Nasdaq 100 down 0.7%, underperformance in semiconductors, and a sell-off in the bond market. See the US 10-year yield up 16 basis points to 3.34%, its highest level since mid-June. And that follows 3 straight weeks of declines on the Nasdaq 100. There's this feeling that we'll continue to see declines, especially when you take into account earnings revisions. If you come with me into my Bloomberg terminal, simply put, for 13 straight weeks, we've seen downgrades to earnings estimates outnumbering upgrades, and that is a worrying signal as we enter a period of the year that actually isn't traditionally very strong for equities. And as always, there are some stories out there in the news cycle, some names we're keeping an eye on. And a day where there are only 29 names in the green on the Nasdaq 100, Tesla, the biggest points performer to the upside, the Apple 24 hours ahead of a key event where we hope to get new details on the latest generation of iPhones, the biggest points laggard on the Nasdaq 100. And then 2 key names I've been watching. Ubisoft, US-listed shares of the French video game maker actually surging as much as 17%, pairing that gain to 4% on news that Chinese giant Tencent will double its stake in that company. And Altria ultimately closing down 1%. It spiked higher on headlines crossing the Bloomberg terminal that Juul, in which it has a 35% stake, which is worth a lot less now than it originally was, has reached that settlement with 33 different states, which I know you're going to cover later on the show, Em.
Absolutely. Ed Ludlow, thank you. We'll talk to you later. Meantime, Juul Labs, as Ed said, agreed to pay $438.5 million to 33 states. This resolves a 2-year bipartisan probe into the e-cigarette maker's manufacturing and sales practices, the states claiming that it marketed addictive nicotine products to children. Bloomberg's Eric Larson joining us now to discuss. So, Eric, tell us how significant this settlement is today.
It's a very significant settlement. It's certainly the largest that Juul has had to pay to date involving any individual states. You know, in the last year or so, the company had settled a few state lawsuits by Washington State and North Carolina, and really had all this huge investigation hanging over it in the meantime. So clearly they decided to be done with this particular risk, although clearly there's a lot of lawsuits still pending out there, but this definitely does away with a lot of the lawsuits that could have been filed by these 33 states and Puerto Rico.
So, how much does this resolve these, hundreds of other lawsuits, essentially? How much of Juul's legal troubles go away as a result of this?
Well, it definitely is significant that these states have settled, but there are still over 2,500 civil lawsuits, like personal injury lawsuits, that have been filed by individuals, and also dozens of cases filed by state governments and school districts. In fact, in November, the San Francisco School District will go to trial in the first of these cases to go to trial, which could really show the potential for how a jury might react to the evidence once it is presented. So that's another one that potentially we could see a settlement before it hits trial. But there are over 2,500 suits out there, plus several states that are, including New York and California, by the way, which normally are, have the potential for big settlements or damages. They have lawsuits pending against Juul that are still pending.
So Juul's agreed to stop a number of different marketing practices as a result of this settlement. What are they, and how big of a change will that be from the company we knew before?
Well, we should note that Juul said in a statement today that all of these things that it has agreed to not do, it is already not doing, is the way it put it. It said it voluntarily changed its business practices a while ago, as you know, the writing was on the board here about how it was, the hammer was coming down on some of these marketing practices, but it's no longer going to market to youth. It's not going to do most social media marketing, not going to use cartoons and ads. It's agreed to not do public transportation advertising. It won't be using anyone who's under the age of 35 in any advertising. A lot of things like that, no sponsored products, no free products. Quite a wide range of activities normally associated with the marketing that it's agreeing to not do, including, importantly, only limiting to FDA-approved flavors, which it used to, of course, have lots of different candy flavors, fruit flavors, and now they've done away with that.
All right, Bloomberg's Eric Larson, thank you for that update. We'll continue to watch how those civil suits evolve. Meantime, coming up, an update on private markets and VC. We will be speaking with Sheila Patel, Vice Chair and General Partner at B Capital. This is Bloomberg. Let's take a pulse of the VC market and declining market conditions as fears continue about a hawkish Fed, and talk about what is the future of venture capital after the growth at all costs mantra of the last couple of years. I want to get to Sheila Patel, get her insight on this. She's the Vice Chair and General Partner at B Capital Group. Sheila, thank you so much for joining us. So curious, just what is your reaction of to a continuing hawkish Fed? Obviously, we're getting mixed economic data, some that looks better than others. But what does this mean for your world and your investing strategy?
Look, I think venture capital has been in an amazing run for the last decade, and it was inevitable that we'd come to a more difficult time. That said, looking at the environment we're in today, looking at everything you mentioned, the Fed, the geopolitical environment, I actually think it's a great time, just as it's been in the past when you've gone through vintages or cycles that are difficult in private equity, in other segments of the market, to really look at VC today and the technological innovations that are driving future innovation and really future productivity. So to my mind, the pullback is actually necessary and a good thing for shaking out where we need to be in VC.
So where are we in VC? Talk to us about trends you're seeing in the private markets. Are valuations still too high? Are there more valuations that are going to come down?
Look, I think as you're seeing in the latest rounds, you're seeing founders realizing they need to do larger deals, more capital at reasonable valuations. People need cash runway. That's to be expected. It's also reasonable to expect we'll start to see an increasing amount of M&A. And I think many of the reports we're seeing, whether from Citigroup or works that are friends over at BCG with whom we have a strategic partnership have done, suggests that you'll see more M&A, particularly in the software space and particularly in the areas like the back office. So I do think there's room for some valuations to move, but I also think there's room for some incredible innovation to come, even in areas that have seemed the most difficult. I think crypto is a great example of that, where there is an interesting future ahead after this latest downturn.
The question is just how long is this downturn going to last? I mean, we've had guests on the show who are predicting millions of layoffs in tech and that this is going to last 2 to 3 years. Does that jive with your thinking?
Look, I think that's entirely possible. I'm probably a bit more optimistic than that, mainly because I see some positive trends in what's going on as well. For example, a recent survey done by Citi suggested that CFOs and CHROs, so in the financial space and the HR space within corporates, aren't pulling back on areas like software spending. A lot of what we focus on at B Capital are core areas like enterprise. And these are areas where companies can find efficiencies at the same time they're going through more difficult economic circumstances. So in many cases, for certain segments within technology, recessionary environment, or at least even a difficult environment, is not necessarily the worst environment for the business.
Meantime, you're investing in companies that are, taking on big tech or trying to challenge big tech, do things better than big tech companies do. We've been following this big piece of legislation that's been working its way through Congress to rein in big tech, but there's a chance it won't make it before the midterms. What do you think the impact of this legislation could be, and what's the impact if it doesn't happen before November 8th?
Look, I think around the world, the technology industry has proven itself to be incredibly adaptable. And this is not the first time or the first region or country to take on issues within big tech. We've actually seen it where I lived for many years in Europe. And you've seen the tech industry continue to adapt. And I think many within the tech industry are eager to adapt. Right? Technology sometimes moves faster than human capacity to handle it. So to my mind, whether the regulation happens before or after the midterms, some amount of regulation to big tech is coming. And I think everyone's accepted that. Everybody's ready for that. The real issue is making sure that it's addressing the right things and really solving the right problems that people have concerns with.
So what's your advice to your portfolio companies right now? Potentially we're in a prolonged economic downturn. There's a lot of uncertainty ahead. We're moving out of an era where there was, a lots of money flooding in, but now, investors want to see real numbers.
Yeah, look, I think it's a real chance to go back to their knitting, and I think this is where you really see, particularly as we look at portfolio companies, the best in the management side come to the fore. Founders that think about things for the long term, founders that have a sense of their use of cash, their burn rates, and really maintaining their runway, but also have a sense of the competition and realize if they're in a moment right now where some of the competitors are facing more difficult times, they need to be aggressive. They need to think about ways to push themselves, their business, their products forward as solutions in a difficult environment. And I think you see many of the best founders and innovators able to put that hat on that says, my idea is the best idea. I've put it together. This is when my competition is showing the signs of weakness or the challenges of the way they've managed their business. And so this is when it's my time to shine.
So where are you placing your bets in terms of where you think we're going to be this time next year?
I think this time next year, hopefully, we look at it as a more stable time. I think what we've said repeatedly from our perspective is we invest over many quarters. We don't raise a fund and think, let's all get it put to work right away. So I think you'll still see us slow and steady investing in a year from now. I think we'll be very focused, again, on the areas where we see opportunity. So enterprise, thinking about the evolution of crypto. My colleagues, Matt Levinson and Ryan Savell, just wrote a great piece about where does crypto go from here and where crypto and fintech merge. And to this moment, most of what's gone on in crypto has really been driven in many cases by speculators. But where do the real world applications come in as you think about emerging markets, as you think about removing middlemen, which you've already seen blockchain do in a place as unlikely as India, in getting money to rural areas and so on. So I think we really still are thinking about where do the ideas of today that may not have been applied well get applied in real world situations tomorrow. I'd say climate tech is another key area for us that we see will be important over the next several years.
All right, Sheila Patel, B Capital Group Vice Chair and General Partner. Thank you, Sheila, for sharing your thoughts with us. Meantime, Theranos founder Elizabeth Holmes claims a key witness in her criminal case visited her after the verdict and expressed remorse about his testimony. Holmes alleges that a former Theranos lab director showed up at her home and said his testimony had been twisted by prosecutors. She's now asking for a new trial after these allegations. This just weeks before Holmes is scheduled to be sentenced. Coming up, the creator economy is booming, how this new industry is changing the face of entertainment and continuing to grow. We'll talk about that next. This is Bloomberg. Taking a deep dive now on the creator economy, which has experienced a massive boom over the last several years, along with a slew of platforms like Spotify, Instagram, and TikTok, and the ruler of them all, of course, YouTube. To give you an idea, every minute, at least 500 hours of footage are uploaded to YouTube. Let's break this all down with Roberto Blake, a content creator who also has his own coaching program that helps influencers build their online brands, and our very own Mark Bergen, who is out with a new book today called Like, Comment, Subscribe, Inside YouTube's Chaotic Rise to World Domination. You can buy it now. Mark and Roberto, thank you so much for joining us. Mark, I want to start with you. Can you just start by giving us a sense of how big the creator economy is today and just how much it has grown on all of these different platforms over the last several years?
Yeah, there are estimates out there that it's about 100 billion, which is from 0 to 60 within maybe the past 15 years, really. And certainly in the past 5 years, I think that's just exploded as all these platforms have got involved. You know, that mind-boggling stat about 50 hours uploaded. The other major stat is that there are now over 2 million creators in YouTube's partner program, which is actually a smaller number than it was before. If people in the audience remember that YouTube actually cut that number, and it's been around 2018, but it's been gradually moving it up, and particularly as they're facing new competition from TikTok.
Roberto, you were a graphic designer and a freelancer before becoming a YouTube content creator. Why did you make this big job change? And give us a sense of a day in your life.
I mean, that's a great question, Emily. For me, a lot of it comes down to the things that are obvious for people is you want more time freedom. You want to be able to talk about and do things you're very passionate about. You want to feel a sense of ownership over the things you're doing. So when you work in, for other people, whether it's as a freelancer or if you work at an ad agency, something I used to do, it's great. It's very gratifying. It's very fulfilling, and it's very legitimate in the eyes of your relatives. But when you get to do something of your own and have complete ownership of it, get to build it with your own two hands, you feel directly supported by a community of like-minded people, there's nothing like it, nothing in the world like it. And so I think that's what attracts a lot of people to the creator economy and opportunities like YouTube, podcasting, and live streaming.
Why do you focus on YouTube in particular and not TikTok or Instagram?
Well, I've been with YouTube almost since the very beginning, and YouTube is still the most powerful search engine in the world across all ages and all demographics. And YouTube has a sense of permanence with its content. YouTube's also the best monetization opportunity for content creators. It has over 8 in-platform monetization streams. I teach content creators roughly 15 different ways they can monetize, primarily using YouTube specifically. But I also do understand and value other platforms. I have a presence in other platforms as well. But I feel that even with the rapid rise of TikTok, I feel that there's nothing like the permanence and longevity that YouTube content creation has. And if you talk to TikTokers on a regular basis, which I generally do, you'll find that a lot of them have the intention of pivoting and moving to YouTube at some point in their career, because they do want a sense of stability and permanence, and they also want the potential for evergreen content to benefit them and be monetizable in the future. They know right now with the TikTok Creator Fund that while they're getting something in exchange for their content, they know they're disproportionately underpaid for the attention when compared to traditional content on YouTube, as well as in the live streaming community. And within YouTube, live streaming and podcasting, there are higher opportunities in terms of direct compensation when it comes to sponsored content and brand deals, and it's not even close. So for me, that's probably one of the bigger deals.
Not even close is one way to put it, Mark. You know, we've talked so much about the threat of TikTok to YouTube, but to Roberto's point, it is a lot of disconnected content and it is less permanent. How big a threat is TikTok really, in your view, to YouTube, and how is YouTube addressing this threat internally?
Yeah, I think it's a viable threat, and certainly more so than Instagram and Facebook have tried multiple times to really build out a creator economy, and thus far have failed. What TikTok and ByteDance needs to do is to demonstrate, Google has a remarkable system, as Roberto pointed out, both for search and for monetization. It's the world's biggest digital advertising company, and it's had this machinery in place for years. TikTok clearly has a lot of political problems, and they haven't really got a proven yet that they can be a threat to YouTube at large scale. So YouTube's response so far is Shorts. This is their feature that's sort of short video. They're pushing a lot of viewers there, encouraging creators to go there. They're about to flip the switch on monetization. It's unclear how productive that will be for the company and how they're going to sort out monetization. But if there's if history shows us anything, that is that YouTube has a pretty strong track record of sorting this out, and I think responding to the threat of TikTok in a really significant way.
Roberto, you're the founder of Awesome Creator Academy, which is a coaching program that helps influencers build their brands online. We had some fun watching your videos earlier today. What trends are you seeing, and what are you telling creators today? Advice that might not be obvious.
I think the thing that is not obvious to most content creators is their potential, their overall potential when it comes to their earnings, and the fact that there is a compounding effect from their content over a period of time. So what a lot of creators don't do is they rely so much on platform monetization, whether it's TikTok and their creator fund or YouTube and their AdSense partner program and things like that, that they don't explore other monetization opportunities, and they don't think of what they're doing as what I refer to as content as a service. So that's one thing that's not obvious to them, is that it's very much almost like software as a service, which most of us are familiar with. We have these wonderful subscription programs everywhere now that we're all paying for. Well, content creators have an opportunity to use content as a service as leverage, not just with ad revenue, creator funds, and sponsored content brand deals, but they can build their own communities around things like their 100 or 1,000 truest fans, and they could have monthly membership programs of their own, whether on platform or off platform. They need to look at things that give them recurring revenue outside of the platform. I'm telling more creators to look into opportunities to build their own products, build their own merchandise. YouTube recently partnered with Shopify, and they also expanded their creator monetization program with regard to merch and even physical and digital products. Used to have a 10,000
We're gonna
subscriber.
have to leave it there, Roberto. It's so fascinating. We're gonna have to log on to YouTube and watch your videos to find out the rest, but appreciate you joining us. And of course, please buy Mark's book. We'll be right back. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in Palo Alto. I want to get back to a check on the markets and shares of so-called meme stocks on the move. Bloomberg's Ed Ludlow back with an update. Ed.
Yeah, and one name in particular, which is Bed Bath & Beyond. That stock falling for a fifth straight day, its worst run since July. It follows news over the weekend that the company's CFO, Gustavo Arnau, died on Friday after falling from a skyscraper in Manhattan. The company saying that they have appointed an interim CFO. You see that decline more than 18%. Reminder that this is a stock that in the month of August surged by 90%, caught up in the meme stock frenzy where retail investors discussed this, other stocks on forums online such as Reddit. That decline being felt in the market. You see other so-called meme stocks like GameStop down 8%, AMC Entertainment also down. But the activity around this area has really dropped off. If we use call volumes as a proxy, we've seen the fewest call trades in this space, particularly for names like GameStop, since 2020, nowhere near the frenzy that we saw in early 2021. I want to look at the space as a whole, and the Roundhill meme ETF, which does not include Bed Bath & Beyond, but you can see, like the broader equities market, it's faced 3 straight weeks of declines. The concern around the Fed and higher rates also impacting so-called meme stocks. But it was interesting to see some reporting on the Bloomberg terminal while I was away, about this idea that when we got a return to school, also meaning a return to college, that we might see the frenzy in meme stocks pick back up, because a lot of the traders that are doing this are young. They're discussing this online in their spare time. That hasn't really been the case. We've seen that sort of negative sentiment around meme stocks continue, with Bed Bath & Beyond being the exception in the month of August. But tragic news, of course, relating to that company. And our thoughts, of course, go to Arnaud's family.
Such tragic news, Ed. Thank you. for that update. I want to move on to the IPO market now, on pace for one of its worst years in decades after an incredible amount of deal activity, of course, last year in 2021, leaving many companies with few options as they wait for the market to calm down. Joining us now, Equities and founder and chief strategy officer Phil Hazlitt. So, Phil, I believe last time you were on the show, you said the IPO window is totally sealed shut and not opening for a very long time. Do you still believe that?
Yeah, well, it must have been a heck of a party at the Playa at Burning Man, because it's been incredibly quiet this morning and today with news. You know, we normally see kind of a stampeding of IPO news and big funding rounds on the day after Labor Day, companies really eager to get out there and announce something big. And we've seen barely anything. So I'm a bit surprised that, you know, kind of post-summer that there's still been a lull of activity. In fact, we're kind of starting to see that maybe some deals are getting done, but a little bit more discreetly, maybe with a bit more structure. And so I think that, you know, the thesis remains the same, that actually the IPO window is still pretty quiet.
And yet we're hearing that Instacart, for example, is still considering going public this year. Why would a company do this now when conditions are so unfavorable?
Sure. I think there's a subset of the private unicorn companies that have such a large brand and such large cachet that really the only way to continue elevating awareness and creating a currency to buy smaller companies is really to go public. Instacart, I guess, could continue to raise money in the private markets, but if they really want to have extra prominence, they are going to tap the public markets. And they've also kind of created a clean path to do so by kind of already knocking down their valuation publicly, having a very senior executive team, including the CEO. And so I kind of think of it similar to how maybe a company like Alibaba or Facebook, maybe even in tougher environments, still elected to go public.
So how long do you think the IPO window is going to be frozen shut, double locked, as you say? You know, what is the time frame that companies should be planning for?
Yeah, I keep pushing it out more and more. I kind of think of what's happening now as really what happened during the start of COVID, but it's just being stretched over a longer period of time. If you recall, kind of April, May, and June of 2020, IPOs were pretty much at zero. And what we're seeing is almost just kind of a stretching out of that. And what you now see is basically a game of chicken between investors and allocators and IPOs and companies that are ready to go public. If you're a company that is profitable and good stewards of your capital, you can wait as long as you need to. But if you're a company that elected to grow at all costs and burn cash, you're going to have to come to markets at some point. What I actually think may evolve a bit more is that we'll see some more M&A activity, both for strategic investors and also from private equity investors that see some opportunities where deals can get done with a bit more structure, a little less public scrutiny. So I think we expect that to pick up quite considerably in absence of an IPO market that's active.
I wonder how many more valuation cut downs we'll see, though. I can imagine that you've got a lot of VCs out there sitting on portfolio companies that have valuations that are just not right for the times.
Absolutely. What I think will start happening is more and more deals that are actually happening kind of behind the scenes are deals with structure. And what I mean by that is that investors are getting much more preferential terms for the money that they're putting into companies. I think we just saw recently that Joker is planning to raise money at a just slight valuation bump up from their last round, but it also basically gives a guaranteed 40% return to the new investors. More and more of those deals are happening. And here at Equities End, we're also hearing of those deals happening as well. And so I think those will continue. But to your point, there's a lot of investors that do want to see some exit and some realization of the investments they made. It's becoming very hard for venture capital firms to raise their next fund when they can't actually return capital to their limited partners. And that's, you know, creating some very tense board meetings, which again is something we've talked about and kind of harped on, but I think the fact remains true.
What's happening inside these tense board meetings? I mean, a lot of these VCs have also raised huge funds and they don't have anywhere to spend their money.
Yeah, absolutely. It's I think the best thing you can do is that the show must go on as far as companies operating and executing and selling and kind of realizing their vision. It may just not kind of proliferate and show up in news articles and updates, right? People are still buying enterprise SaaS software. They're still buying cybersecurity solutions. It's just that we're getting fewer and fewer data points on what those companies are really worth. I think at some point we'll start to see some companies that will, you know, quietly exit and sell themselves to big tech, which, by the way, big tech has been incredibly quiet on the M&A front. I think that'll change soon. And so, you know, it's just going to be, I think, a quieter kind of media period for these companies, even though, as I said, these businesses keep operating and keep selling.
All right, Phil Hazlitt, EquityZen founder, chief strategy officer. Great to have you back, Phil, as always. Okay, coming up, it has been 180 days since President Biden signed that executive order on digital assets. What does the rest of the government think about it? Kristen Smith of the Blockchain Association joins us next. This is Bloomberg. A slew of reports are due this week to the White House stemming from President Joe Biden's executive order on digital assets, including one on the future of money, payment systems, and the implications of a U.S. central bank digital currency, though these reports likely won't be released to the public till mid-September. Let's talk about what we can expect with Kristen Smith, Executive Director of the Blockchain Association, along with our crypto contributor, Shanali Bosick. Thank you both, ladies, for joining us. So, Kristen, what do you think we're going to find in these reports?
Well, I think it's really interesting. I mean, this is the first time that the federal government has looked at crypto regulation from a comprehensive perspective. You know, as you recall, President Biden issued this executive order back in March. He gave various federal agencies, both financial regulators and some non-financial regulators, mandates to look at different issues, to look at some of the concerns we have with this space, but also some of the benefits that the crypto industry and sector could provide, and come up with recommendations about what types of regulation are needed going forward. So I think that we're going to see a fairly balanced analysis. I think we'll see some things around competitiveness and inclusion that the industry is going to be very excited about. I do think we'll see some concerns around, you know, sort of the lack of regulation of dollar-backed stablecoins, which is something that has been discussed for a long time, maybe the need for some spot market regulation. But overall, this should provide a pretty substantive roadmap for policymakers should they choose to accept it as they consider legislation this fall and into 2023.
Now, Blockchain Association has had a seat at the table with policymakers. How have they been processing this crypto winter and all of the drama?
Yeah, well, listen, I think, you know, there's an understanding that crypto is here to stay, right? Like that wasn't always a concern. And even in this market downturn, I think policymakers have even more incentive to try to do something in the space, especially if you look at the beginning of the summer, we had the collapse of Terra Luna. We had a couple of bankruptcies. We had sort of the Three Arrows Capital. You know, there were a bunch of events that had big impacts on consumers. And instead of pushing away from this space, policymakers said, all right, this is a space where we need to make sure that we fill regulatory gaps. We need to better understand what regulations already exist. We need to figure out what are the options going forward. And so, you know, Congress has been pursuing several different bills this year. We saw the Lemus-Gillibrand bill earlier this spring. We've seen the Digital Commodity Exchange Act in the House. We have a new bill in the Senate that attempts to regulate this space. So they've been generating their own ideas. And I think, you know, the executive order process and Congress's effort are going to converge quite nicely to have just an overall more educated policymaking group that is looking at this in a thoughtful, comprehensive way, in a way that, you know, moves the ball forward, but not so rushed that we get the policy wrong. And so I think we're really setting the stage up to get a good bipartisan compromise and fill those regulatory gaps.
But what about the agencies and regulators themselves? Because even though the executive order was seen as a really big step for the industry, a common critique I get when I'm talking to market participants is that it really emboldened each of the agencies separately, that there's a lot of conflict among them on how they define certain issues. You take the SEC and the securities issue when you come to Coinbase in particular. So do you see the agencies consolidating power to one agency or another? And how do you believe that Congress may enable that or conflict with that?
Yeah, well, the executive order did require cross-agency collaboration on different topics. I do think the core issue out there when it comes to regulating the crypto markets, like particularly the Bitcoin markets, you know, those that are truly commodities, is that today neither the SEC or the CFTC has jurisdiction in this space, right? What we need is Congress to come in and say, all right, we have this commodity spot market. Other commodity spot markets, like the grain market, for example, they don't have any federal regulator. So we need to find a new federal regulator to come in and regulate the spot market. And so I think Congress has a choice. What's interesting is that the three major proposals that have been introduced in Congress so far have all pointed to the CFTC as being the appropriate regulator for the crypto industry, probably because they already have regulatory powers over crypto futures and on fraud and manipulation in the underlying market. So I think that that's probably the place it's going to end up. It could also go to the SEC as well, but Congress seems to think that they want to give this authority to the CFTC.
And what does it mean for the SEC if more of that moves over? Because there's so many things that they were looking at, NFTs, other securities issuances potentially here. Do you think the SEC ultimately loses some power over these markets as they've already started on the enforcement path?
Yeah, well, I would argue they don't have any authority over, sort of the pure crypto commodity markets, right? I mean, the SEC has authority over things that are securities, and you can use blockchain-based systems to issue, equity, to tokenize shares of stock. When you have something that's truly a security, the SEC is obviously going to have a role to play there. I think the problem has been for innovators is that there really is a big gray area there. It's hard to know when they apply. And what we just need is a framework that addresses these concerns. And, the stakes today are pretty high from a regulatory perspective, right? If you're deemed a security, you're regulated by the SEC. If you're deemed a commodity, a crypto asset commodity, there's no regulator at all. So I think by having a regulator, perhaps the CFTC, to regulate crypto commodities, then there's still going to be consumer protection. There's still going to be market surveillance. There's still going to be disclosures that help give consumers more information and investors more information. And so it won't be such a high stakes decision if something is a security or a commodity. So I think that will help pave the way for a more constructive dialogue. Once if Congress does indeed give the CFTC jurisdiction.
All right, Kristen Smith, Executive Director of the Blockchain Association. Always appreciate you joining us and taking us inside these rooms a bit, alongside our own Shonali Bosick. Thank you both. All right, coming up, getting ready for the kickoff. 2022 NFL season starts this week. We're going to get into full gear with Jason Robbins, CEO of DraftKings, to talk about the sports betting front for our new series on the intersection of sports and technology. This is Bloomberg. With NFL season kicking off, we are exploring the intersection of sports and technology all week long. Today, we're starting with sports betting, now legal in 31 states, with Kansas being the most recent to join the field. DraftKings and rival FanDuel are positioned to maintain their leadership of daily fantasy sports, a market that has ballooned to $4 billion in terms of annual entry fees. DraftKings predicting this football season will be the biggest moment yet for sports bettors. Joining us to discuss, CEO Jason Robbins himself. Jason, great to have you back with us. Give us a status update on the numbers and just how much you think NFL kickoff will kickstart an already booming industry.
Well, I mean, this is our holiday season, to make an analogy. So, this is when all the numbers go up, and it's a fun time of year. A lot of work from the team goes into preparing for this. We've launched a lot of new features and products over the last 60, 90 days, including our new Rainmakers football game, which I'm really excited about. And week one's going to be fantastic. I'm really looking forward to it.
You're also launching a new blockchain initiative whereby bettors will be able to collect digital player cards. How will this work, and how big do you think blockchain and Web3 will be for sports?
Well, Rainmakers, which is the product you're referring to, is, I think, one of the most innovative things we've done ever. It takes fantasy sports, which, the idea is you're like a GM and you have players that you get. And it immortalizes that ownership in the form of, an NFT on the blockchain. So instead of drafting a player, you buy that player's NFT and you can play that in a game So it's really exciting because it mixes things that our customers are really interested in, which is the game and this sort of idea of being able to pick your favorite team or your team that you think is going to win, with also a strong interest our customers have shown in blockchain and collectibles. So I think it's really a new way of looking at fantasy sports. We think it's the future of fantasy sports, and we're really excited by some of the early traction we're seeing. There's sales that are going off for big dollars on the marketplace right now.
FanDuel seems to have pulled ahead of the industry in terms of market share. What's your play to counter that?
Well, it's definitely seasonal. We typically do better in the NFL season where we have a big boost of customers. And if you look at the iGaming side, we're ahead of them by a little bit. So we're just going to keep trying to have the best product. For us, we think product is what ultimately will win the customers over. And we think the more people that we get to show some of the new things that we launch this NFL season, the more they'll be excited about keeping their play with DraftKings. So we're just going to kind of keep, focusing on product, focusing on customer experience. We think being the most customer-focused and customer-centric, which entails having the best product and overall experience, is what will win the day.
So, obviously bigger business has also meant at times some bigger losses. Some of your competitors have said they're going to pull back on ad spend this year. How is your spending strategy changing as the market evolves? And also, we're heading into a potentially prolonged downturn.
Well, we've always been very, data-driven in our decisions around spending. So we look for paybacks that meet our threshold, which in the case of customer acquisition is typically 3-year payback or less. Same thing on new states we launch. We typically look for a 2 to 3 year path to profitability timeline. So we haven't really changed that. I will say, though, that with some of the competitors pulling back, we're able to achieve great results without having to be quite as aggressive on the advertising promotion front. We're still being very aggressive. This is an important time of year, so we're making sure that we have a presence out there and we get in front of customers and we get good offers that are interesting to them. But I do think the competitive environment is rationalized quite a bit year over year. If you compare it to this time last year, it's really just night and day.
Also got a big election coming up. You've got some proposals on various ballots in California in particular. California could become the largest sports betting market in the world next to the UK. You've backed a proposal that would allow DraftKings to offer sports betting anywhere in the state in partnership with various Native American tribes. There are various other proposals that are countering this. What is your polling showing you about the likelihood of your proposal passing, and how much are you prepared to spend between now and November?
We're seeing really good things in the polling. Obviously there's a lot that's going to occur between now and the election. It's still about 2 months away, but everything we're seeing in the data is great. And we think more importantly, policy-wise, it makes sense. It's something that Californians want. Those that are into sports betting in California, most of them are already doing it anyway in the illegal market, which is generating no tax revenue and has no consumer protections. And our initiative will generate hundreds of millions of dollars a year to help combat homelessness and mental health issues in California. And we also partner with tribes that are getting a cut of it as well. It'll help especially a lot of the smaller tribes that aren't as maybe fortunate as some of the ones with the bigger casinos do well, and really will help with education programs and other things for those tribes. So we think it's great for the California sports bettor. It's great for those that want to see real help on the homelessness and mental health issues, and it's great for the tribes. So we're really excited about it. We think it's great policy for California. Polling numbers look good, but there's a lot of time between now and the election, so we just got to keep getting our message out there, and hopefully it'll resonate with voters.
All right, one word answer, Jason. Who are you putting your money on for the NFL playoffs?
I'm a Patriots fan, so I got to say Patriots. I'm not putting my money on them, but I'll be rooting for them. But there's a lot of great teams this year. I'm really excited about the opening game. I think it's going to be awesome, and it's a really good season. A lot of great play. NFL content has never been better.
Jason Robbins, CEO of DraftKings, great to have you. Thank you. We are at Apple tomorrow. You don't want to miss our special show. This is Bloomberg.